How do you avoid PMI with a second mortgage? Are you wondering how to avoid private mortgage insurance while still making a smaller down payment? You're in the right spot. Let's break down how a second mortgage can help you with this. Private mortgage insurance is usually required when you put down less than 20% on a conventional home loan. This insurance protects the lender if you default on your loan, but it adds extra costs to your monthly payments. A popular way to avoid this cost is by using a second mortgage, often referred to as a piggyback loan. So how does this work? The most common structure for a piggyback loan is called an 80-10-10 loan. In this setup, the primary mortgage covers 80% of the home's purchase price. Then, a second mortgage, which can be a home equity loan or a home equity line of credit, covers 10%. Finally, you make a 10% down payment in cash. This combination gives you a 20% equity stake in the home right from the start. With this setup, you avoid paying private mortgage insurance because the total financing from both mortgages plus your down payment equals 100% of the purchase price. Since you have at least 20% equity, lenders do not requiring private mortgage insurance. This reduces their risk because you have substantial equity in the home, and the second mortgage serves as additional collateral. Now, let's consider some important points for real estate investors. While piggyback loans help you avoid private mortgage insurance, they do mean you will have a second monthly payment. Often, the interest rate on the second mortgage is higher since it is subordinate to the first mortgage. It's essential to calculate whether the savings from avoiding private mortgage insurance outweigh the costs of this second mortgage. Managing two loans means you need to plan your finances carefully to ensure you can meet both payments. This planning is vital to avoid any risk of foreclosure. If you're looking for alternatives, making a full 20% down payment is the simplest way to avoid private mortgage insurance. However, this may not be feasible for everyone. Some government-backed loans, like those from the Department of Veterans Affairs or the United States Department of Agriculture, do not requiring private mortgage insurance, but they have specific eligibility requirements. Another option is lender-paid mortgage insurance, where the cost is included in a slightly higher interest rate instead of a separate private mortgage insurance payment. You can also consider refinancing later to remove private mortgage insurance once you have built enough equity in your home. Using a second mortgage as part of a piggyback loan is a practical method to avoid private mortgage insurance while minimizing upfront cash requirements. However, it is essential to weigh the costs and risks of carrying two loans against the savings from eliminating private mortgage insurance. Careful financial analysis and planning will help you determine if this strategy aligns with your investment goals.